Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, the whole market is wishing for a rate cut. We're ramping up into it, but we're going to tell you why you need to be careful in that scenario. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have a chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much more than what you put into it, and we'd like to see you in the room. Thanks for listening.
Okay, Bob. So, right now the market is like bad news is good news, because bad news is going to make the Fed become dovish and they're going to get rid of these high interest rates. But that's not all it's cracked up to be, is it?
No, and this is where you have to be counterintuitive on this, because remember when they started raising interest rates, everybody thought the market was going to crash, and the market went ahead to all-time highs.
Right.
And the same thing happened in reverse. So you have an environment where history tells us, this is one of the highest percentage correlations out there, Phil. The minute the Fed starts cutting interest rates, you got to go defensive. And this chart I'm going to show you is the detail behind that, but it also tells you where to move your money. And so you have an environment here where you have an average market decline of around 30% or so, and then you have an average move higher in the long-term bonds of almost 26%. So it's really a no-brainer trade. You may be caught in the slack sea between the tides here for a month or so, but history tells you that that patience will be well rewarded. And that's what Phil and I have been talking about all along here is, we're going to get a little bit of sell the news event in this environment. And you have a situation where a lot of people are going to actually buy into that move, and they're what's called exit liquidity, meaning big money is going to sell to retail that can't read a history book. And so we're getting in that position now. And, my view still personally is that the high will come between August 15th and the end of that month is my view. But I could be happy to wait for a Fed rate cut to get fully defensive as well. Phil, you have a chart that we always show people. When this happens, you better be short as well. You want to throw it up there?
Yeah. So it kind of ties into this graph you have here, which is showing us that when the 10-year declines. Now, that plays into the 2-year yield as well when it comes to the yield curve, and that's what this chart is here. So the upper chart there, the upper half, is the yield curve. That's what that line represents. And in that upper half, you also have this green, transparent kind of ghost pattern of bars, and that's typically what we would expect to see in terms of the yield curve normalizing, and we're not seeing that yet. This is turning into one of the longest running inverted yield curves that we've seen. So what Bob's graph is showing is that when the 10-year declines, and that's going to be because there's going to be a rotation into bonds. So the stronger the bond bull is, the more the 10-year rates will decline. And so you're going to run into a situation where they call that the bull steepener, because you're going to get a recession trade and you're going to get a rush into bonds, and the yields are going to drop in such a way that it actually makes the yield curve normalize. All right. Right now, the front end of the curve, like say the 2-year, is yielding more than the 10-year, and that's not supposed to be the case. And so we got an inverted yield curve, but that will undo. And then you'll have the opposite, where then the yield curve then steepens, and it steepens because there's a bull market in the bonds. So that's what we're looking for. And this chart here kind of shows you that the market tends to want to go down once that yield curve hits zero and then goes positive. So we haven't seen that yet, and that's why the market has basically been given the green light to make higher highs, even though the data we're showing you, the consumers drying up, unemployment starting to creep up, all that stuff that can continue to happen into a market blow off. And the reason for that is because personally, I think the institutions know that when a rate cut comes, it's usually because the unemployment rate, Bob, is going north of 4.5%. So you have an opportunity to basically squeeze the market up into a sell event, right? So it's buy the rumor, sell the news. The news in this case, I think the catalyst is going to be the unemployment rate, and then we're going to start running into a whole cycle, quarter after quarter after quarter, of bad news is bad news. So right now, bad news is good news because that's basically this narrative that the Fed's going to be dovish, and that's bullish. And historically that is, but it's not really bullish. It just means that we're running up into a sell the news event. So we got to watch the yield curve. As long as it stays negative, I think you have to understand that the market can continue to make new highs. And I think that means that we could potentially see SPX trading over 6,000, Bob, and Bitcoin over 100K.
Yeah, and look, the market hit my one fib line extension, and the next extension's at 6,700. So I wouldn't be shocked if we even got that high. What's really interesting to me is that I think we may play some catch up too. Today the energy got bid because it's been suppressed here going into this, witch. So July and August tend to support energy, and so we may get maybe a more balanced move higher in the market. AMD just reacquired its 9 SMA fill, so I think on the weekly. So I think there's going to be a chance here for a bit of a bull run. Guys, remember too, this is really long lasting inverted yield curve, and that means it's probably going to be a more intense sell off. And I'll let Phil talk in a second. I think, we look at 100 weeks basically for this cycle then to unwind. It's going to test a lot of people's patience in this. And the other thing too about this signal, this is one of the very few signals that you could be proactive on. Most of them you're reactive to the market change. This one you can be proactive. In fact, you may get a couple paper cuts waiting for the roll off. But in this environment here, you may want to start converting yourself into defense when you get that first rate cut. And if they front run the Fed, when you get that yield curve to invert, remember that once they cut on that very short end, where the Fed funds rate, that 2-year will drop like a stone, and that causes that bull steepener, and it'll just move right up through the curve. And so you're going to want to be prepared for that. And, those people aren't going to wait around for that 2-year to mature. They're going to drop that thing like a stone. And you're going to get a situation where everybody and their brother is going to see bull steepener. And then reference one of our older videos that we did film. We talked about bull steepeners and bear steepeners and what happens in those environments. But needless to say, you don't want to be too long equity in that environment.
Yeah, and the yield curve, basically the thing that everyone looks at is the 10-year yield minus the 2-year yield, right? So when you go into a recession environment, the typical way that they do it is they're going to bail on equities because, equities, I know outside of bubbles, really you need fundamentals to drive. You need basically company growth, earnings growth, right? To drive all of those things. Otherwise, they're going to go to the safety of bonds. Now, if you're in a recession, you go off of statistics, and that's going to tell you that you're basically looking at, 18 to 24 months on a really long recession that you need to find shelter. You need to beat the market if you're a fund manager or you're managing somebody else's money. So a perfect solution for that is the short end of the yield curve, which is the 2-year. So you're going to pile into that, and that's going to drop the yield curve down more than, say, the 10-year, because that's a perfect window. 2-year, 3-year bonds, you can hold those. Face value of the bond's going to increase, and you're going to lock in those yields, those APRs, which you're not going to get from the market because the market's going to be in decline. So the market's going to be yielding negative returns, negative face value versus the bonds that are going to be positive face value and positive yields. So all of that is the classic recession trade. That's how the big money outperforms the market. In a bear market, you can too. You can go long things like TLT and get out of stocks. You just have to do some shuffling around in your portfolio. If your 401k or your IRAs are self-managed and things like that, you can move that stuff around. Really important to do that because, as I've always said, if you can do that in one bear cycle, just one, doesn't matter if you catch any of the rest of them, you do that once in your lifetime of your portfolio, especially if you're on the younger end of your time horizon in terms of career and stuff like that on those retirement accounts, you'll forever outperform the market. You just have to get one right, and you'll be set for the lifetime of your portfolio. So, and then at that point, all you got to worry about is just not retiring into a severe bear market. So if you're getting close to retirement, you definitely want to probably just segue everything to cash and, not sweat if the market keeps going up the last couple of years of your retirement account. But that's the way to go. And so that's why this is really important coming into the next 12 months here, is that because we have one of these opportunities and we've been starved of one because of all of the stimulus and everything that the Fed's been doing. And we haven't had a recession for about 14 or 15 years. So this one could be longer, and and deeper than average, because average recessions come about every 5 to 6 years, Bob.
Yeah, and the other thing too is, we have massive, massive, massive amount of derivative activity now. So remember, if this market, even if it sustains a non-move, volatility will collapse on those option contracts, and that will also draw the market down because the market makers don't have to be long those stocks or long the futures market to hedge. You'll start seeing those evaporate, and that's my biggest worry here. Is we're going to get a recession, we're going to get an option reset, if you will, in terms of the amount of derivatives that are being created every day. And we're going into a secular period of time when people are actually retiring, Phil. So your theoretical that you just point out to is actually reality for most people. If I had a normal job, I'd be retiring in 2 years. Okay. And I'm at the very end of the baby boomers. And so a lot of these baby boomers are now off, and they're sitting there. They have no choice but to sweat bullets or to get smart and start being able to play the rotation game here more effectively. And if you're listening and you want to get this information real time and also some other trades that are going to do well in this environment, just come check us out at tradelikeagenius.com. Got specials running, got a great room. Somebody told me today, they said, Bob, we like your signals, but we're actually where the value is the mind share that goes on here. You said, it's incalculable how each trader's been helping each other fill in this room. So you guys, you get a master class here in terms of expertise and knowledge, not just stock trading, but really the market itself, and really how to look at your portfolio in a whole different way and a more effective way, I would venture to say.
Yeah, so if you guys want to join us, head over to tradegenius.co, check out our packages over there. You can get into the room with us. If you want to get into the VIP room, check out the VIP room package, and that gets you into where Bob and I are speaking every day, and we're talking about what Bob just described. Other than that, thanks, Bob. Let us know your thoughts below, guys, on our yield curve coverage here and on the yields going down. When do you think that's going to happen? When do you think we're going to start seeing this yield curve go positive? Leave your comments below. We'll see you guys on the next video. Take care.
Trade Genius.